This is Capitalize Your Finances, the show representing you, a select group of excited, ready, and fired up listeners seeking to potentially maximize your money moves and get after it. We don't settle for generic advice of always and nevers. Our currency is our intellect, and we constantly seek the logical way of likely creating advantages to potentially maximize wealth for your personal and unique situations. This show brings you the step-by-step framework to capitalize your finances in all aspects of your financial situation, and we strive to explore strategies and ideas to potentially help you capitalize on your financial decisions. We are capitalizers, and this is our show. Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Panayiotou, the Cap and Capitalize. And today's episode is one that I've been asked to create for many, many months on how to capitalize on inflation. Now, as I'm recording this on July 28th of 2022, inflation is the highest it has been in decades. Gas prices are through the roof. The cost of food is compounding at an alarming rate, and everyday utilities costs have increased substantially. In early 2021, inflation was already there. We just didn't see it, or chose not to see it. For the prudent few, the warnings seemed obvious. Unfortunately for many, the warnings were simply ignored. Like just about anything in the world of finance, we do not feel the immediate effects of our actions until it is too late. This does not mean that too late always refers to negative news. Positive news is just as relevant. In an episode of the past, I cannot remember exactly what I said regarding when people got back into the stock market after 2008. But if my memory is correct, it was something like 3 to 5 years. Regardless, the point that I'm making is that the signals were there and they are here today. The time has come and gone. And now we are left with the question, what on earth do we do when inflation is as high as it is? The first step I would recommend, take a step back and take a deep breath. For younger listeners, you have to understand that this is most likely the first uncomfortable economic scenario you have lived through in your professional career. A couple months ago, I was hanging out with a group of friends all around my age, so early 30s. Now, I'm going to tell you that it is a blessing and a curse to be the Cap and Capitalized, because anytime I am in a conversation, whether it's with one, two group of people, and the topic of finance comes up, 10 out of 10 times the eyes fixate on yours truly, and people expect me to have all of the answers lickety split. This time was no different, and what struck me as odd was the conversation went from zero to where do I need to invest my money today in about 10 seconds. And it struck me as odd for several reasons. As a precursor to my reasonings, I should mention that I have told these friends that I do not want to mix business and relationships, as I grew up with many of these guys and or have gone from professional colleagues to buddies, and the mixture of money could jeopardize that. This is really important because, first of all, I knew next to nothing about most of their holistic financial situations, so I would need a tremendous amount of information to give them a remotely close to accurate answer on the investment front. And the second thing that struck me as odd was the level of concern they had in their voices. It was if they had never lived through an economic downturn in their life. And as I later discovered after researching my hunch, I wasn't wrong. I mean, they have never known that feeling could exist. Think about it for a moment. If you started working from 2009 or from 2009 through essentially January of 2022, in general, the economy has been hitting on all cylinders. Now, whether it was actually crushing it or not or just being helped along the way, that's an entirely different subject matter. But the point still stands that things have been pretty darn good. I compare this to generations before mine, as historically the more vintage crowd has experienced roughly 2 to 3 economic downturns over a roughly 13-year period. I mentioned this conversation that I had not to tell you what I told my friends. I tell you this because the question that was asked was more likely than not 100% the wrong question to lead with. Now, let me explain. And I promise this will get to the answer on inflation, sort of. For those of you that are in your 20s, especially your early 20s, through, I'd say, 50, what do we know inflation is going to do to your everyday spending? And that's easy. We know it's going to cut into your ability to make more than you spend. We also know that if you are close to living paycheck to paycheck, it is certainly not going to help your situation. But here's the good news. Inflation, just like nearly everything in the world of finance, comes and goes. Unfortunately, this is how it goes for most. So we start with inflation being invisible. But if everyone can continue to afford things and companies can keep raising prices without everyone's day-to-day spending being affected, well, why wouldn't they? It's a match made in heaven. But then the second part, inflation starts to compound. And let's face it, history has shown us that as a whole, both people and companies tend to get ahead of themselves. And before you know it, both companies and people get greedy. When you look around and you see all of this greed, stay cautious and start thinking about getting financially defensive. Unfortunately, side note, there's a ton of unfortunates in this episode. Sorry, everybody. Greed's compounding starts to take effect, and then the real predicament occurs. So then the last part, inflation becomes a tremendous issue. And at this point, we all know times are not great and inflation is very visible. I remember a couple days ago, I was at my chiropractor and I had a conversation with their wonderful front desk girl that is grinding her way through college. Now, she not so sarcastically told me that she was now saving up for a bike because she couldn't afford gas, like at all. And on a grander scale, the companies and people that got ahead of their skis suddenly realize that they have been living in a false reality as costs on goods to produce their products increase. The Federal Reserve starts to increase interest rates to combat inflation, sometimes desperately. And then the real sad stuff happens. Companies start cutting employees because they can't afford their already inflated salaries, and the companies can't afford themselves. I don't think I need to explain what happens after that. But for those of you that are very unaware, it's easy. It's game over. Instead of asking where to invest, why don't you ask yourself, how can I prevent myself from being on the wrong side of game over? And that's a great question. But before we answer it, I'd like to give a shout out to today's sponsor, Capitalizers. This episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you are at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, you're at the pinnacle of your career, you're winding down into retirement, or you're thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have me, Christopher A. Paniotu, the Cap and Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial.
For those that are in their 20s through 50s, after taking the deep breath, my first point of attack would be to comb through your monthly expenses. It sounds super mundane, but think about it. When was the last time you actually gutted your monthly expenses to see what you spend your money on? In times of inflation, it is arguably the best place to earn a free return on your money. So check this out. According to a survey conducted by OnePoll back in 2019, the average American spends $1,497 per month on non-essential items. That adds up to nearly 18 grand a year on things that you don't need to begin with. If you think of it this way, if you found an investment that was paying you this dollar amount per year, and it was a 4% interest rate, you'd be $450,000 richer. Now, who the heck wouldn't do this deep dive? Now, I'm glad I got your attention with this one. Whether it's subscriptions you don't need, impulse purchases, step away from Amazon, or dining out all the time just to keep up with the Joneses, you will quickly realize that this first step could change your life. Another way to think about it, those of you that have listened to this podcast since the beginning are probably contributing to a company retirement plan. In 2022, if you're under 50, you can put in $20,500 per year into your 401k plan. So if you gutted your spending habits, you'd be able to max out your retirement plan and have something to spare. And again, I'm assuming that you've already contributed up to the match, because the episode Capitalize on What Money Goes Where, that was well worth a re-listen or listen to if you are a new capitalizer tuning in. If you have debts with high interest rates, especially floating rates, if you have any excess money after your company's 401k match or whatever type of retirement plan your company offers, and you have the proper 3 to 6 months of emergency fund cushion in your savings account, it'd be best to pay those puppies off as soon as you can. I remember hearing an old friend of mine saying, when times are troubled, it's nice to not owe anybody anything. And when it comes to those high interest rates, which I would say anything above 6%, I could not agree more. Now that we got the easy wins out of the way, the next question comes down to what was originally asked by my buddies and one of the most popular questions asked in today's economy. Where should I invest my money in an inflationary market? Let's start with the longer term investments. Take stocks as a nice starter entree. As I'm recording this, depending on where you read, since the start of 2022, the stock market is down roughly 20%. And why is that? Well, there's a ton of reasons why, but a good place to start is the fact that many companies that people were buying into weren't actually doing all that hot. And what made things worse, these companies were able to get away with it sheerly due to the highly addictive drugs, emotion, and FOMO, fear of missing out. Due to the fun of being highly regulated, I am not going to go into specific companies that are not doing great. But what I will say is that this is the first year in a long time where it pays to actually know what you are investing in. Crazy, right? I'm not merely referring to the name of the company and the ticker symbol. I am referring to how the company is performing. My interview with Todd Tracy went in depth into how important the 3 financial statements are when trying to understand a company's success. But Tog admits that he focuses on smaller companies that are not necessarily publicly traded on the stock market. But regardless of the size of a company, you must understand a number of key factors before you choose to buy a company's stock. A couple of questions worth asking, although the list is much longer than this. Mine is, that is. Number one, is the company making money? And diving further, how is the company making money? Is it sustainable? Number two, does the company have enough cushion to withstand tough times? Number three, what are the odds this company becomes obsolete? Number four, does this company have a ton of competitors? And then lastly, do you actually know what this company does? Or did you buy it because your friend's friend told you it's a good company? For the past 13 years or so, and for sure 10, let's face it, when the stock market is climbing, most people ignore just about every important question worth asking when it comes to deciding whether or not to buy a stock. For those of you that choose to buy an index fund or index funds, individual company analysis is probably not all that important or enticing. However, don't think that simply invest in an index fund is going to get you to the promised lands, because you can still very well invest inopportunely. One question you should ask yourself is, when times are tough, how difficult is it for new companies to grow, expand, and survive? I can tell you from starting a business of my own, regardless of the times, it is tough starting a business. So, all things being equal, times of toughness are, well, much more difficult. Another question may be, is inflation hurting the entire globe or just the economy where I live? With indexers, you can't just arrogantly state, I'll be fine because I'll just invest in an index. Because history has shown that there have been some pretty unfortunate outcomes. There were the two lost decades of 1972 to 1982 and 2000 to 2010, where if you invested in the S&P 500, which is the most commonly followed index out there, the stock market was essentially flat. Sure, you had more money at the end of the timeline than when you started due to contributing, maybe getting some income, etc. But world records were not exactly shattered in the investment return department. Maybe in a bad way, but again, I digress. People say that diversification is important, but when people refer to diversification solely within the stock market, that doesn't sit well with me. Luckily, there are other places to look to invest outside of the stock market. You've all heard me talk about the alternative investment landscape before: real estate, private equity, business development companies, hedge funds, and interval funds, just to name a few. In the stock market, if you truly understand what you own and you have an actual thesis as to why the company will do well in the future, that is mission critical. In the alternative space, it is no different. However, the way to go about analyzing these investments takes a slightly different approach. So let's start with real estate. Obviously, there are different kinds of real estate, but what's not so obvious is how these different real estate investments do in times where it's more expensive to, well, do everything. Can people get away with not paying rent? Do companies still need to run their operations out of specific types of buildings? Are people vacationing as much before? Where will people store their excess stuff, regardless if they are moving, trying to get rid of belongings and need a temporary stash spot, or simply have more stuff than they currently need and their dwelling can't hold it? Now, I wouldn't necessarily lean into the question, what sector of real estate would be the best, as much as I would drill into the question, where could I get hurt the least? People lean on the blanket statement, real estate is great for inflation. But in times of inflation, you can't simply lean on blanket statements, because Blanket statements are fragile, and eventually, if you are not careful, fragile items shatter. I'm not going to dive into private equity, interval funds, or hedge funds too much, as it really comes down to how the investment is structured. So, for example, is it focused more on buying struggling companies? Is it more of a buy solid businesses and hold type of play? Is there a ton of turnover within the investment strategy? The list can go on and on. But what I will say is that depending on the specific strategy of the fund, there could be a tremendous amount of possibility, or you could completely lose your tail. Super helpful, I know. But in all seriousness, it truly depends on what the fund is trying to achieve. Look at what they have done, not what they have said. I am not talking about returns as much as I am talking about what they have said they would do in the past, what they did after that, and the reasonings in doing so. That's a big difference. One area that has gotten high praise, especially in the inflationary market, which is very interesting to me, is the business development company arena. But more so for interest rates rising. It's not really a direct hedge against inflation. Coincidentally, as I'm recording this, interest rates are on the rise to attempt to combat inflation. Indirectly, these BDCs, generally speaking, benefit with rising rates because of the nature of the loans that they're writing, because generally they're floating rate loans. I would agree that this could be a plus, but I want to caution listeners because people forget one very key point. What happens if interest rates rise too much and suddenly these companies cannot pay their loans? As long as the company can pay their loans, there shouldn't be any issues. But again, you have to know what you are buying. Let's switch gears to the over 50 crowd, as well as the not so long-term investments. When you have rising interest rates and inflation, I hate to tell you this, but on average, it's going to be tough, like really tough. Checking and savings accounts are not earning yet anything per se, although it's critical to have that emergency fund stashed away in case it gets messy. Once you get beyond that emergency fund cushion, it gets a bit tricky with money markets or CDs. Until interest rates increase enough, the punch won't really be there. And in order to earn a hearty return like years past in the bond market, it's best to dampen those expectations, as the years of 6% way back in the day when interest rates were plummeting from the 1980s until essentially 2022 are gone, and at least at this rate. It's nice to have liquidity, and bonds do offer that. But all I'm saying is they are more likely than not going to have a slower growth return or slower speed of return, which only leaves a couple options available for conservative money. And those are credit and something that I've not talked about up until now, something known as a structured product. But with heightened risk and or illiquidity, you simply can't bank on one or the other. I have stressed it's not an either or, it's and many times. And times of inflation, it's no different. However, what is slightly different today is that with the costs on the rise, so is the understanding the true risks of these tools at your disposal. For the 50 and over group that is closer to retirement, you've heard me discuss the value of certain types of lifetime income annuities. Due to the fact that these are contractually obligated products that guarantee certain strategies, some guarantee income, others growth, etc. The one thing you won't have to worry about is, well, actually, you do have to worry. Not about the guarantee necessarily. I'm talking about the company itself. Now, there are a number of different tools at your disposal in regards to studying the financial health of these insurance companies and You guessed it. In times of inflation, it pays to partner with a company that can actually live up to the guarantee. Now, the good news is that once you know the company can do so, the underlying strategies of the annuity selected will be ready to provide you with what you signed up for. Downside? These aren't liquid. So you better have that cash in your emergency fund, and it wouldn't hurt to layer in some conservative money alongside your rainy day fund. When it comes to inflation, just like any financial topic, really, people look for the surface level answer. As you can tell after listening to today's episode, there is much more to it than that. But I hope that I was able to provide you with thoughts on how to capitalize on inflation to the best of your abilities. I know inflation isn't fun, but again, going back to earlier in today's episode, just like you, I don't want you to be on the wrong side of game over. Now that's it for today's episode on Capitalize Your Finances. And as always, I am so thankful for each and every one of you capitalizers turning in. If you have any questions about today's episode, you know the drill. Give me a call at 253-214-3050 or shoot me an email at chris@capitalizeyourfinances.com, as the Cap and Capitalize is always here to help you out. Next time I have you all back, tying into inflation, I mentioned to you all that interest rates are ticking up. So my next episode, Capitalize on Interest Rates Rising, is next up on the docket. Until next time, keep crushing it, get after it, and keep capitalizing. Take care.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Capitalize Your Finances or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index that includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Investments in non-traded business development companies, BDCs, are subject to significant risks. These risks include, but are not limited to, limited operating histories, reliance on the advisors, conflicts of interest, payment of substantial fees to the advisors and their affiliates, and illiquidity. If you are able to redeem shares, they will generally be redeemed for less than the original amount invested. Investing in these products may not be suitable for all investors. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. You should carefully consider the investment objectives, risks, charges, and expenses of a mutual fund, interval fund, or non-traded BDC before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor or the issuer directly. You should always read it carefully before investing or sending money. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Structured notes, equity-indexed annuities, and variable annuities discussed are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Variable lifetime income annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Certain terms and conditions apply, so please read insurance company materials carefully. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial. Todd Tracy is not affiliated with Capitalize Your Finances or LPL Financial.